Ladies and gentlemen, good day and welcome to the Q4 FY22 earnings conference call of High-Tech Pipes hosted by Ambit Capital. High-Tech Pipes will be represented by Mr. Arvind Bansal, CFO. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dhruv Jain, analyst from Ambit Capital. Thank you and over to you, sir.
Hello everyone, welcome to 4Q FY22 earnings call of High-Tech Pipes. From the management side, today with us, we have Mr. Anish Bansal, whole-time director, and Mr. Arvind Bansal, the CFO of the company. Thank you and over to you, sir, for your opening remarks.
Good morning and welcome everyone for our Q4 FY22 earnings conference call. I am joined on the call by Mr. Arvind Bansal, CFO of the company. I hope everyone has had a chance to go through our results and updated investor presentation uploaded on the exchange. We are delighted to report double-digit net profitability in Q4 FY22 continuously for third quarter in a row. EBITDA per ton of rupees 3,511 in Q4 FY22. The proportion of value-added products has increased to 27% in Q4 FY22. It is continuously growing quarter after quarter. Strong profitability despite of volatile market conditions led by Ukraine and Russia crisis. In the reported quarter, volume has increased by 26%. Primary reason for increase in volume is focus of the company on sale of value-added products, good demand in the market, and aggressive branding activities. The sales realization has improved considerably year-on-year basis, primarily led by increase in steel prices and higher sale of value-added products. Though the raw material prices have increased on YOY basis, we have been able to improve our operational efficiencies, which has benefited us in margin improvement. Now, I would like to go through the 4 major developments and initiatives during the ongoing year. Firstly, Sanand Phase 2. The company has started commissioning of the large diameter pipes, LDP pipes project at Sanand, Gujarat. Capacity of this new greenfield project will be 60,000 tons per annum. LDP pipes to be manufactured at this facility will be used for transportation of water, gas and oil. There is a big demand of these specialized pipes, especially for the city gas distribution network. And this upcoming facility will cater demand for the sector. Trial production for this project is expected from Q3 of FY23. The second development, color-coated roofing sheet project at Secunderabad. The company has started commissioning of color-coated PPGI roofing sheets at its Secunderabad facility. This project is the forward integration to our existing cold rolling and continuous galvanizing line facility to manufacture value-added products. Capacity of this new value-added product will be 50,000 tons per annum. The roofing sheets are being used for rooftops, domestic, industrial, wall cladding, metros, infrastructure, railway stations, etc. Trial production for this project is expected from Q2 of FY23. The third development, production of high-tech solar torque tube. The company has started commercial production of solar torque tubes. These steel tubes are used specifically for solar trackers. Quality and service of these tubes is very well accepted in the market. Going forward, the demand for these tubes are going to increase exponentially in the times to come. Fourth initiative is the corporate branding. The company has started aggressive corporate branding and product branding activities on various social media platforms including Facebook, Instagram, LinkedIn, YouTube, etc. The company has also started aggressive advertising campaign over various radio channels on pan-India basis. The company is also doing a lot of BTL activities such as fabricator meets, dealer meets and customer meets on pan-India basis. All the above four developments should contribute significantly towards top line and bottom line growth in the coming years. We are also committed and focused to optimally improve the capacity utilization of our existing plants and also increase the proportion of value-added products. At the same time, we have clear vision to reach 1 million tons capacity from current 5.8 lakh tons. With robust demand, we are very optimistic that the company will achieve good volume growth in FY22-23. I will now hand over the call to Mr. Arvind Bansal, our CFO, to take you through the financial results for Q4 FY22. Over to you.
Good morning, everyone. I will take you through the financial results of Q4 FY22 and FY22 for full year. Quarterly performance of Q4 FY22 versus Q4 FY21. Our revenue from operations for the quarter grew by 52% on year-on-year basis to 595 crore rupees as against 392 crore rupees. The revenue growth was primarily driven by significant increase in our sales volume of value-added products and higher realizations. Sales realizations has improved by 24% to rupees 70,000 per ton as compared to 56,500 rupees per ton. EBITDA for the quarter increased by 55% to rupees 29.86 crore as against 19.31 crore. EBITDA per ton for the quarter stood at rupees 3,511 rupees per ton as against 2,861 rupees per ton, which is an increase of 23% on year-on-year basis. Our PAT increased significantly and stood at rupees 11.22 crore as against 6.52 crore. Now I will take you through the yearly performance FY22 versus FY21. Our revenue from operations for the year grew by 40% to rupees 1879 crore as against 1341 crore in FY21. Our EBITDA for the year increased by 42% to rupees more than 100 crore rupees as against 70.8 crore rupees in FY21. EBITDA per ton for the year stood at rupees 3634 per ton as against rupees 2861 rupees per ton in FY21, which is an increase of 39%. Our PAT increased significantly and stood at rupees 40.3 crore rupees as against rupees 20.8 crore in FY21. Current ratio has improved from 1.37x in FY21 to 1.43x in FY22. Interest coverage has improved from 1.96x in FY21 to 2.52x in FY22. Debt equity ratio has improved from 1.45x in FY21 to 1.42x in FY22. ROC has improved from 13% in FY21 to 16.3% in FY22. ROE has improved from 12% in FY21 to 17.4% in FY22. Net working capital days has improved from 71 days in FY21 to 67 days in FY22. With this, I would like to open the floor for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nikhil Chaudhary from Chris Portfolio. Please go ahead.
Yeah. Hi, sir. Good morning, and thank you for the opportunity. Congratulations on a great set of numbers. I wanted to understand, in this volatile environment where prices, raw material inflation has been a concern for even the bigger players, what has been your sense, like on the demand outlook, considering the situation that we are in? will it be probably robust going forward, what we have seen in the past 3 quarters, or something that probably you are seeing it can be challenging if the inflation doesn't cool down from here on?
Good morning, Niket. As we have all seen, the last financial year was, full of volatilities. First it was the COVID, and then there was the extended monsoon period, and then we had the Ukraine-Russia crisis to end with. So basically, the volatilities may remain there for another 3 to 4 months, because now the China lockdown is causing impact on the prices of all the major commodities. So we see the pricing being to stabilize in Q2 of FY23. So once the prices are stable, I think then the environment is more conducive towards growth of the volumes. So we expect prices to be range bound in Q2, and whatever prices will be there, I think those should come in line with international markets and as with the domestic expectations.
Understood. Sir, just probably I didn't probably dwell a lot into your dealers, but in respect of the other pipe companies, what was getting a sense like dealers are probably not stocking enough because they are probably not comfortable stocking at deep prices. They feel prices on, then they'll stock. Is it something that we are also witnessing, or probably our industry is altogether different and that is why it doesn't impact us a lot, because it is more driven by what happens to the construction space and all? Just wanted to get a sense on that.
So Niket, in our industry, what happens is, the consumption is already there. Only the inventories with the distributors, they may, increase or decrease with the price volatilities. So right now we are facing, little bit, destocking from our distributors. But once the prices are stable, because this month we are expecting a sharp correction in steel prices. So once it's done, the restocking will start. So overall, the quarter should not be affected.
Okay. And sir, last thing, since I'm new to this company, wanted to understand how probably our customers are willing to accept the price hikes. Like, is it easy for us to probably pass on the price hikes, or we do face resistance? Like, I understand this is a wide phenomenon, everyone knows, but how easy it is for us to probably pass on the price hikes?
So basically, the price hikes, they are done across the industry by all the players. So once, it is done by all the players, then it is not as difficult to pass on the price hike.
Okay.
So we are the converters, conversion space, and, we are increasing the value-added products so that, the product basket is rich, so that, there is no dependency on one particular segment.
Understood. What probably, sir, do you feel can be a demand damper in this year, or you are really confident like we'll do a very good, like what we saw in financial year 20 to financial year 23 will also be something similar? I wanted to understand the antithesis.
So from the demand side, we are very optimistic. The demand should remain strong for this financial year. The projects, they are there. The demand from the domestic consumption, so it is going to go up. So we are not concerned about demand. So having said that, we are confident of doing at least 20-25% volume growth for this financial year.
Oh, this is great. Understood, sir. I come back in the queue. Wish you all the best, and congratulations again.
Thank you.
Thank you. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi sir. Thank you so much for the opportunity. The couple of questions. If we look at if I look at a broad margin profile on a per ton basis, you were broadly at about that 2,000-2,500 rupees of EBITDA per ton, which in the year of FY22 has moved up to almost about 3,600. So broadly, if you can just help us understand the reasons for these increases, and if steel prices to correct, I'm more talking from an annual basis, is there a risk to that margin that you have been earning?
Yeah, good morning, Abhishek. increase in our overall blended EBITDA per ton is due to the increase of value-added products in our total contribution. So earlier we were having around 15 to 17% contribution from the value-added products, which is risen to almost 25 to 27% for FY22.
Okay. And sir,
eventually our focus is to increase the share of value-added products up to 50% going forward in the coming years.
And when you refer to value-added products, you're largely referring to the GP pipes and the GI pipes, right? And not the MS and the hollow round.
Yes, coated pipes and certain SKUs in black tubes also are upcoming. The color-coated sheet segment, the LDP pipes. So these all will contribute towards the value-added products.
Okay. So even if there is a element of lower steel prices which has moved in excess of 70 rupees per kg, even if it was to fall to 50-55 rupees per kg pre-crisis, you don't perceive per ton basis your EBITDA per ton to meaningfully decline. Is that a right assumption?
Absolutely.
Okay. Fair. Sir, the other thing is you've started this new product line of color-coated tubes. Can you just articulate in terms of how big is the market size? What are the opportunities? Who are the key players? Just some thoughts around there will be helpful, sir.
We are starting the color-coated sheet segment, not the tube.
Yeah. Sorry, my bad. Color-coated roof sheets. Yeah.
Roofing sheets. So this is a big market. This may be as big as the tube and pipe segment, and this market is also going by at least 12 to 14% per annum. Because earlier there was in roofing in the rural segment it was all asbestos and cement sheets, but now these are being replaced by the metal roofing.
Okay. So who caters to this segment today? Like tubes, we know there are.
So base has also consolidated to a large extent. So only primary players are there in this field now, majorly.
So all those who are making the steel, those players have only forward integrated and make the roof sheets also color coated.
Correct.
In
so
this
right
also the market should be healthy.
A handful of players.
Okay, and you think the margins also here will be fairly healthy?
Yes, absolutely. We should expect a EBITDA per ton of 5,000 to 6,000 rupees per ton from this segment.
Okay. Got that. And just a couple of questions. You also spoke about the solar opportunity which you are doing it with your product. How big is that opportunity? Again, what's the competitive scenario like? If you can just help us understand that.
So this is a fairly very new product from the Indian context, and earlier the penetration of solar trackers was very less, but due to the increase in the solar module prices and other balance of plant systems. So basically, solar tracker helps in increasing the generation by 20 to 25%. So now the trackers is inevitable for all these solar developers because 20-25% generation means a lot. So that is the only way to set off the price hikes and the solar modules. And we are seeing from last year, there is a shift from the fixed structures towards solar trackers, and also there is a huge export potential from the Indian subcontinent for the solar trackers. So we see a very, very active demand from this space in this financial year. But to quantify will be really difficult, once it is there. But we are very confident that we'll do good volumes in this segment.
You think this can be a 1 million ton market overall?
Yes, could be between 500,000 ton to 1 million ton.
And are all the ERW players also present here in terms of products?
Only a couple.
So is there, where I'm trying to understand, is the process of making solar tubes which is going into these trackers, is it very difficult? Is there an entry barrier, or tomorrow looking at the opportunity, all the ERW players will kind of come into the system? Is my question.
No, here there are a lot of the standards are really high. This is a special SKU, and the raw material is entirely different. We need to have a good amount of integration in our processes. Like we are doing it from scratch, from HR, and then we are doing galvanizing in-house, and then we are doing the tube in-house. So it's all in-house, and very few players have the integrated facility in India.
Got it. Just two last questions. Your volumes are also a function of price differential between tubes made out of primary and secondary. How has that gap been trending?
So that gap, Abhishek, is varying during the year. Sometimes it is high, sometimes it is low. But once the steel prices, they moderate and they come to at their rational levels, I think then this primary, eventually the primary market is has always sustained. The secondary is it comes and goes. So once the prices stabilize and the price differential goes down, then all the share will be with the primary players.
But do you believe the differential has increased a fair bit, and if that was to normalize, your volume growth can be much higher? Is that something that you kind of have a view on?
Yeah, differential has been high over the last full year, in fact.
Correct.
So, as the prices moderate and they come down to the, to the reasonable levels, then I don't think, the secondary, because the products made from secondary are very, very, there's a big gap in the quality from the secondary and the primary. Secondary, the tubes and pipes are basically, there is hardly any, consistency in the chemical composition, and there are a lot of defects in the so it's a basically it's a a very, very cheap version of MS tubes and pipes.
Sure. And just one last question from my side is, in terms of you mentioned that in the month of April, May, or particularly in the month of May, there has been some amount of destocking. So typically, what is the broad inventory levels that you'll sit at in terms of days?
So basically, the raw material inventory is around 20 to 25 days, and finished is also about 20 days.
And finished is 20 days.
Yeah.
And okay. And receivables also would be around 30-35 days, or how does it differ?
Yeah, 30 days.
And what was it in pre-crisis, your receivable days?
Approximately the same level, between 35 to 37.
So it has remained stable. Okay.
Yeah.
Okay. Thank you so much for answering my questions. I'll come back in the queue. Thank you so much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Deval Shah from Phillip Capital. Please go ahead.
Yeah, good morning, sir. Thanks for the opportunity. So by when do you expect this price differential to get normalized between primary and secondary?
Good morning, Dhaval. So we expect this price differential to narrow down significantly by June and July.
And so what is the ideal spread that you are talking about between primary and secondary, which is, historically been there?
5 rupees, 5 to 6 rupees.
Okay. And so lastly, what is your outlook for the, this working capital for FY23 and 24?
So right now, our total net working capital days is 67 days, and we are targeting to bring it down under 60 days for this financial year.
So this will be led by inventory correction or maybe any further reduction in the receivable days?
Both.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Akshay Chheda from Canara Robeco. Please go ahead.
Hello. Yeah, thank you for the opportunity. So my one.
Sir, you can speak closer to the device, please. Your audio is not clearly audible.
Hello.
Yes, please proceed.
Yeah, so you did mention that the color coated sheets gives you a 5,000 to 6,000 rupees per ton kind of a EBITDA per margin. So sir, what will happen if the steel price is correct as you are indicating? So can there be pressure on this? Because I understand that we work on the percentage margins. So if the HRC has to correct, then wouldn't this number go down, or so how should we look at it?
So in case of price correction, steel price correction, it will happen like over a month. So basically, if there is at all, there is an impact, it will be of around, but then it will stabilize, and ultimately it will help us in pulling up more demand if prices, come down a bit and rationalize a bit. So that, the dealers and distributors, they will also restocking, the fear of further price correction, that will go away.
But sir, this understanding is correct, right? If HRC goes down, then the margin should come down, but then operating leverage would help us to improve it. Is that the reading right?
Absolutely.
Okay. And sir, this happens across all our products, even in the GI pipes that we do, because I understand there also we make around 4,000 kind of EBITDA per ton. So even there, the same logic holds true?
Yeah, if the prices come down, our margin in terms of percentage, that will go up. Because ultimately we are focused towards our EBITDA per ton on different products. Okay. So if prices come down, the percentage, the margin percentage, that will go up.
So this is more kind of also you operate on a cost plus model. Is that the right thing then?
Yes, because we are in the conversion space. So cost plus is our model and the industry model as well.
Okay. So I mean, even if the HRC goes down, then EBITDA per ton should be at least managed, is what we are looking at. Okay.
Yes. In fact, it should become better.
Okay. Understood, sir. Thank you, sir. Yeah, this was very helpful, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Akshay Kotari from Envision Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. So I had a couple of questions, like on which geographies in India are we focusing more? So can you give a sense of that?
Good morning, Akshay.
Yeah.
So basically, our current focus is in three major geographies. That is North India, West India, and South India. And this is where the maximum demand and consumption from these regions. And our local manufacturing plants are also located in these locations, North, West, and South. So our focus is predominantly in these markets, and there is a big opportunity in these markets in coming few years. And we'll be focusing actively to push all our products in these three major geographies.
Okay, that's great. And any, what we can say, plans to expand our distribution network? Currently, I think we have 390 plus distributors. So,
yes,
any plans?
This would be going up, sequentially and gradually. But increasing the distributors is not a challenge. Once our products are there, we'll be taking a call on a case-to-case basis.
Okay. And we did volume, correct me if I'm wrong, so we did a volume growth of around 2% this year. And I think you mentioned that we would be growing around 20 to 25% in the coming year. So what would be the drivers for this growth as such? The steel prices coming down and volume expanding. So what would be the basic drivers?
Yeah, a lot of there are a lot of factors. First, the demand should be robust. and the volatilities and the variations we have seen last year, we are hopeful that they will not be there this year, like the early lockdowns and the supply side constraints led by Ukraine and Russia crisis. So all these things, they impacted the overall volumes for the industry. But having all these things, if they settle down, I think the volume growth will be there. There are a lot of there's a big demand from the Jal Jeevan mission, which will take shape in India. A lot of demand from the city gas distribution. A lot of demand drivers from the infrastructure and construction side. So all these things they will help us in achieving 20 to 25% growth.
Okay. And you also did mention about that Sanand plant and supplying to CGD companies.
Absolutely.
So, yeah, don't you think that your working capital cycle would be elongated? How are we looking at that? Because these companies are a handful of them, and so they would be.
In CGD, it is the working capital does not get stretched because there is no credit in that segment.
Okay.
Yeah.
And what would be the share of revenue from government entities or PSUs as such, if you can give a sense of that?
So for this year, I think it shall be between 5 to 10%.
Okay, that's great. And last question. So what would be time cycle we take price hikes or pass on the prices to the channels or to the customers?
So basically, the price difference transmission is fairly very quick. It generally is under 10 days.
Okay, that's great. Okay, thanks for taking my question and all the best. Thank you.
Sure.
Thank you. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for the opportunity again. So broadly, you have sold about 277,000 tons last year, right?
Yeah.
So how should one look at your broad market share?
So in this, you can assume industry size of about approximately 6 million tons.
This includes both primary and secondary?
Yes.
Okay. And how big would be secondary in this?
Secondary would be approximately it is just a ballpark figure between 5 lakh tons to 8 lakh tons.
So you are broadly at about 4-5% market, 5-6% market share.
Yes.
Okay. And if you look at financials of all the companies, right? Everybody seems to have a margin improvement on an EBITDA per ton basis in the last 1.5 years, and everybody is attributing the reason for that to be value-added products. Now, is the market construct itself changing where the demand for value-added products is much higher, or there is a replacement because everybody seems to or there's a lot of growth? How should one look at it from that perspective?
So Abhishek, we have done certain things, over last 5 to 6 years, so which has helped us in achieving this higher EBITDA per ton. And going forward also, we have done a lot of integration, backward and forward integration across all the plants. We have enriched our product offering. Also, we have we have a very very good localized presence in all 3 geographies, in north, west, and south. In west, we are catering from 2 different locations, Maharashtra and Gujarat. South, we are at Andhra Karnataka border, which is catering to 4-5 states. So all these initiatives that we have taken, it is there to ensure that our EBITDA per ton goes on sequentially. And going forward also, our 2 major projects of color coated and the large diameter pipes and the solar tubes. So all these initiatives, they are in the direction of increasing this the EBITDA per ton blended level.
Okay. And just three other things. What is the scrap price differential today?
About 20,000 rupees per ton.
It's almost at a very high price today.
Yeah.
It's almost at its historical highs, right? Because
yeah.
So your April-May volumes would be weaker to that extent.
Well, let's see. The quarter is still there.
Okay, fair enough. And
Yeah.
the other thing is, do you see, because when we see from our lens, we see everybody seems to be announcing capacity on their base. So do you envisage a situation where there's higher supply addition into the system, or there's an overcapacity, or will kind of demand outpace the supply? Any thoughts around this?
So, Abhishek, our capacity expansion is going into, like very, very niche segments, like large diameter pipes. There is a like big vacuum there, so we are going there. The roofing, there is a big vacuum in the roofing segment, and the applications of the color-coated sheets is increasing day on day. So we are very, very focused, where to put up the capacities. So our base capacities, I think they are enough to fulfill our demand, and we are now expanding in the areas where the growth potential is really, really, really high over the next coming years.
So my question was more not just from Hi-Tech's perspective, but generally for the industry. Do you see your competitors, peers, everybody adding capacity because everybody has made cash flows in the last 2 years? So more from that perspective.
So, broadly, if you talk about, on a very, very broader level, like the consumption and the demand will certainly go up in the next 4 to 5 years. So, from the country's perspective, we are targeting, a 300 million ton production and production capacity. There's a big export opportunity that should open up for the Indian players once the logistics and the freights get rationalized. And we are seeing a demand growth of 10% per annum in our segment. So all these things, they will help in achieving the volumes.
Got it. And one last question: is export also a big opportunity for you guys?
Absolutely. It definitely is. Since China has withdrawn itself from the international market, so the next big opportunity lies with the Indian players.
And how are export margins?
They are good, but right now, we are facing a acute, logistics issue because of the Ukraine and Russia crisis, and earlier to that, the lockdowns, and right now also like even the lockdown. So basically, the freights are going up on quarter-to-quarter basis. They are still not rationalized. So once they come down and they get rationalized, I think it will be a big opportunity for the Indian players.
Got that. Great. Thank you so much and wish you all the best. Thank you so much for answering my questions.
You're welcome, Abhishek.
Thank you. The next question is from the line of Nikhil Chaudhary from Chris Capital. Please, Chris Portfolio, please go ahead.
Yeah, hi, sir. Thank you for the follow-up. Sir, wanted to understand on the solar part a bit. Like, have you started testing, or like is it in the development stage? Have you started dispatching for probably testing how the product is moving off among the consumers? Or like who will be our end consumers? Would it be the solar module guys or the EPC guys? Like I understand it should be with the EPC players who will be installing the solar modules on the roof.
Good morning, Nikhil. So basically, our targeted customer would be the EPC guy.
Okay.
Because they gives the whole turnkey EPC to all the EPC guys, and there are plenty of them. And this production has started, and we have supplied a decent volume in the Q4. And going forward also, we have a very, very specialized team for production and market of this product.
Understood. And sir, on the EBITDA margins front, like just like we alluded earlier, like we are intending to increase the value-added products in the mix. So supposedly, if it inches up to 50%, which you are expecting, what should be the EBITDA margins that we should be probably thinking ballpark number would be really helpful.
So see, our target is to increase our EBITDA per ton year on year. So we'll be growing this by couple of hundreds every year.
Understood, sir. Looks very good. Thank you, sir. Wish you all the best. Congratulations.
Thank you, Abhishek.
Thank you. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good morning, sir. Thank you for the opportunity.
Yes,
sir,
good morning.
I want to understand one thing, sir. Our capacities are already double of what we have produced last year. So, considering we want to grow at 25% or more, is it safe to assume that next couple of years we don't need to add any further capacity when the cash flow would largely be utilized to pay down debt?
Yes, because our major capex has already been input. In terms of further forward integration, also it is completed for LDP pipes is also fairly done. So further I think all the major capex has been done, and the focus will be on the utilization and increasing the share of value-added products. So these two are our focus areas for next 2 to 3 years.
Understood, sir. Sir, one more question regarding the overall industry capacity of the construction grade ERW. It is expected to be ranging somewhere around 8 million tons or slightly more. So just wanted to understand so whether the rest of the capacities are not producing or exactly what's the status, because everybody else seems to still adding capacities while you said the market size is close to 6 million tons. So just wanted to understand there whether all those capacities are just nameplate and actual capacity is much lower, or this is the general trend which would have been followed in the last decade or so.
Because there are actually the capacities what are coming up, they are in different segments. So we can't really pinpoint and say it is for this, it is for this. Because steel and tube is being a very diverse product. The applications are numerous, so everybody is expanding in a particular segment, not on general levels. Like our focus is towards the large diameter pipes, the gas pipes, and the roofing sheets. So we have identified certain areas where there is a huge scope of growth. So we are expanding in those directions.
Okay. So just one last question. In terms of raw material procurement, we are still a little bit lower overall. But what is the level? Do you think that volume level? Do you think at which you should get a little bit of negotiating power, getting a little more discount than what is prevailing in the market, which would add up to your margin?
Because I can confidently say that the raw material pricing for our entity is among the lowest in the industry.
So basically, you are already there where you have some negotiating power with the supplier.
Yeah. There's no vast gap, but there is certain number which we eventually would like to bring it down to.
Understood. Thank you for taking my question, and all the best.
Thank you so much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Mernosh Pantaki from Danki Securities. Please go ahead.
Yeah, hello sir. Thanks for giving me the opportunity. So just had one question on your capacity. In your earlier presentations, you had mentioned that through debottlenecking, you intend to increase your capacity from current 580,000 to around 7 lakh tons. So that is largely through debottlenecking, or this includes the current 50,000 tons in Sanand which you have expanded, and also 50,000 tons in color-coated roofing sheets?
Yeah, good morning, Meher. So this includes in the 7 lakh ton, these two major developments.
But sir, this color-coated roofing sheets is a value-added product. So does it actually increase your capacity, or it is the capacity remains the same and is just a value addition?
No. It's the value addition. The overall capacity will remain the same.
So then your overall current capacity, if after both these expansions, will not be 6 lakhs 80,000. It will be 6 lakhs 30,000. Am I correct?
Yeah, 640.
640. That is 60,000 tons of ERW pipes for the
Yes.
city gas distribution.
Yes.
Okay.
Yes.
So overall capacity is 6 lakh 30. And earlier, I guess that your value-added products capacity was 2 lakh 20,000 tons, which will now increase to 2 lakh 70,000. Am I correct?
Absolutely.
Okay. So now this 6 lakhs 40, you intend to take it up to around 7 lakhs through debottlenecking.
Yes, and that will happen in due course.
Okay. So just my second question is on the volume front. So with this 7 lakh tons, as you have stated that you would not go on expanding further, and on this 7 lakh tons you will intend to scale up the utilization and share of value-added products. So what kind of utilization do you expect in, say, not this year, but say FY24 over the next 2 years out of this 7 lakh tons?
It will be ranging between 60 to 70%. 70% is the peak utilization possible.
Okay, sir. Thank you very much. That's all.
Thank you.
Yep.
Thank you. The next question is from the line of Vaibhav Kapoor, an individual investor. Please go ahead.
Yeah. So I just wanted some understanding on the working capital cycle. How do you see it playing out for the next 3-4 years from a longer term perspective? And another linked question to that would be, would there be any change in the days payable in the terms of trade as well?
Very good morning, Vaibhav.
Good morning.
Net working capital days, last year what we have seen is acute supply side shortages, which forces to have higher raw material inventory, because we have seen, acute shortage, so the supply chain got disrupted. So we were forced to have, a little higher inventory levels to ensure the steady supply to all our plants. But this year, we are seeing, the prices getting rationalized, and, they have already peaked out. So we don't feel, a need for a higher inventory from here on. So firstly, the inventory days will certainly, they should come down. And regarding the payables also, the creditors. So overall, this year our target is to bring this down below 60.
Okay.
And going forward in next 2 to 3 years, as the utilization and the value-added products and all these things go on, so this will certainly, go down in the coming 3 to 4 years.
And so with respect to your payable days, it's ranging between 15 and 20 days. Do you see a monthly possibility, or it will be difficult to get to that kind of a number in the long run?
You mean like increasing the number of the payable days, like taking more credit from the suppliers?
Yes.
Yeah, this is very much possible. We have had very recently we have had a rating upgrade also from A- to A.
Okay.
Now I think we'll be in a very we are in a much better position to take advantage of this, and we can take more LCs, BGs, and take credit through the channel financing companies. So that is on the card, and let's hope in this financial year it should get materialized.
And so the second question I have is, with respect to the capex that you have incurred, I just want to know what is the total capex that you have incurred for this new 60,000, and what will be the remaining capex that's not on the March 22 books or numbers?
So approximately there is a 30 crore capex for the color coated sheet, and the same amount for the LDP pipes.
Okay.
And with this, the fair, like 80 to 85% of the capex has been done.
Okay.
And will be approximately around 10 crores.
So you're saying after the March numbers, about 12 to 15 crores of capex is remaining?
Approximately.
And sir, the last question that I have is slightly broad-based. I've been looking at your annual reports, and there's some color with respect to your targets to increase the capacity. But if you look at your investor presentation from FY19 to FY22, I mean, the past 4 years, your volume has been still in a particular range, even though we've been aggressively expanding the capacity. So is there a dichotomy in we being expanding our capacity, but the volume growth still remaining the same? Are we being a little too aggressive there, or are you anticipating something which is not coming to our mind?
So, Vaibhav, the initiatives that we have taken in last 3-4, they are essential for the the growth and the stability of the business. Because these initiatives, if we won't have taken in last 4 to 5 years, it would be difficult to be in this market. So this was essential in terms of capacity. Last 2 to 3 years, the volumes are there where are, because we have seen in 2 financial years, 2 quarters being impacted by the lockdowns.
Right.
Major lockdowns. And this in the last quarter Q4, despite the Ukraine-Russia crisis, we were still able to achieve a good utilization. So going forward from here on, things more or less they have stable down, and I think there is a scope for a good volume growth from here on.
So what you see, the numbers that you have received in terms of volume in the last quarter is what would be an average, a blended average for the next year. Would that be safe to assume?
Yes.
All right. That answers all my questions. Thank you so much.
Thank you, Vaibhav.
Thank you. The next question is from the line of Rikesh Parekh from Barclays Securities. Please go ahead.
Yeah, thanks for the opportunity. And congratulations, good set of numbers. The first question is on the EBITDA margin per metric ton. For the quarter, we have seen some dip in the blend EBITDA margin per ton. So any specific reason? Is it price movement or the mix been changing?
I think this EBITDA per ton improvement, particularly through focus of the company on value-added products and through better operational efficiencies. So you can say due to better product mix.
No, sequentially, quarter on quarter, I'm seeing that the EBITDA was from 3853 has moved down to 3511 as per your slide number 4. Slide number 3.
There's a marginal decrease. In quarter 4, the volume of the company has increased. So there's a little bit pressure on the pricing also. But if you see,
so I just want to understand, it is because of the combination mix, or it was the price which has reduced realizations? Or
basically due to price drop.
Okay. And going forward, what kind of value-added mix we will like to have? We like to maintain or plan to achieve in our
in FY22, we have achieved a value-added product proportion of around 25%. And if in FY23 and 24, we are targeting it to increase it to 35 to 40%.
35 to 40%. Okay. Second thing is on the volume front. I think the fourth quarter we did an impressive 87,000 metric ton of volume sales volume. So how far this is sustainable, and by any chance does it include any export component in it?
It includes some export component also. And as Anish Bansal ji has mentioned, for FY23, we are targeting a volume growth of 20 to 25%. And as per the current market scenario and as per our product basket, that seems to be very much achievable.
Can I have some breakup? Means what means export probably we did for the first time, or means that is a sustained export we have been doing till now?
Export of pipe we have started for the first time, although we are facing some logistics issues at present in this segment. But in the times to come, we hope that all these issues should be sorted out, and we should achieve some good volume in export also.
So my understanding is that export is largely of the GI pipe, lower value added product as such, or do we have a higher over there in export? We have a value added product also.
It's of only value added products. Export.
Export is only value added product.
Value added, yes.
Okay. So probably this 87,000 odd ton what we did. So will it be safe to assume that we'll be able to achieve the same kind of volumes for the next year going forward? Sustainable this levels of volumes?
Yes, certainly yes.
Okay, thanks. And lastly, on the I joined a bit later. What will be the capex for the current year and next year? What we have already planned?
For current year, the capex will be around 15 to 20 crore rupees.
Mm-hmm.
And next year there will be only token capex around 10 crore rupees.
Okay, sort of more of a maintenance capex. Last on this venture into the solar front. So any meaningful tie-up or volumes have we started on the solar side?
Actually, we have just started this new product. And as Anish Bansal has mentioned, there is a good potential in this product. So we are doing tie-up with all these EPC manufacturers.
Anywhere accreditation or approvals or impanelment required or something of that kind with?
It is already done.
That is already done.
Already done.
Okay. And my last question on the roofing sheet, what we had last introduced last year. So how the traction and I think so it is more of a B2C kind of a thing. So how the volumes are happening?
Volumes are picking up step by step, and the quality of the product is well appreciated in the market. And hopefully in the current financial year, we should see a good volume growth in this product.
Okay. Thank you. That's it from my side.
Thank you. As there are no further questions from the participant, I now hand the conference over to Mr. Bansal for closing comments. Over to you, sir.
I take this opportunity to thank everyone for joining on the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with us over email. Thank you.
Thank you. Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference. We thank you all for joining us, and you may now disconnect your